Super. So welcome again. My name is Samantha Masoke. I'm the project director for IFR for NPO. Welcome to this roundtable consultation event for INPAG Exposure Draft 2. I can see some names of people who were already joined us this morning for 90 minutes, and you're here for another 90. So thank you so much. Do put your name and your country in your Zoom name if you like. And if you'd like to join a breakout in Spanish, please put ES. And if you'd like to join a breakout in French, please put FR into your Zoom name so that we can put you in the correct place. So today is an opportunity for us to hear from you. It's not a teaching, it's not a webinar. We will do some very brief framing comments just to make sure everyone's in the same space. But it's really hoping that many of you are already familiar with the content of ED2 and willing and able to share your views on it. Your voice really matters. If you've joined on a mobile phone, you might want to instead join on a laptop because the breakout rooms don't really work very well with mobile phones. So if that's possible, please join on a laptop. So without further ado, a very brief introduction. You'll remember that INPAG is based on the IFRS for SMEs accounting standards with modifications for non-profit specific accounting issues. Next slide, please, Paul. Thank you. Now, the development of INPAG is very much a joint effort. If you click through, the CIPFA and Humentum in partnership with CIPFA really taking the lead on the writing of INPAG, but we're working with a large number of volunteers, technical, practitioner, there's a donor reference group, and a number of country champions. And I know many of you in the room here are in some of those roles, and I'd really like to call you out and say thank you very much indeed. If you'd like to go to the next one, yeah, thank you. We have stakeholders from all over the world. You can see actually the green ones here are in the governance group, and I can also see some members of the governance group on the call today as well. This really is very much a global project, and I'm really excited for you to have the chance to meet each other as well as to tell us your views. It's as much for you to meet each other and discuss and bounce off each other. Super, next slide. So you'll know that we've had the exposure draft in 3 parts, if you like. We're now in exposure draft 2, which is the main accounting, substantive accounting proposals. Exposure draft 3 is very much under development. We're having a final meeting, tag meeting next week, and looking to publish that in May. So work is very much ongoing. And the comment period for exposure draft 2 ends on the 15th of March. So we really hope that the discussions you have today could be a springboard to you submitting a substantive response, having discussed some of your ideas in this forum. Moving on, please. So there's 4 key topics in ED2. Revenue, both revenue from grants and just other normal. I've been muted. There we go. I'm unmuted. All is well. As well as, so grants revenue and also grant expenses for grant makers. Today, we'll be focusing in on the grant revenue piece. There's also inventories and foreign currency translation, which we'll be covering in this second session that we're in now, which is perfect. So the overall flow is that we have 90 minutes, 50 of those minutes will be spent on revenue, and then we'll have 35 minutes on the other topics of inventory and financial FX, foreign exchange gains and losses. So without further ado, let me hand over to Paul, who's going to be taking us through revenue. And I think we'll have some time of framing, some time in breakouts, and some time to feedback from those breakouts. So Paul, over to you.
Thanks, Sam. So we've got the framing, group discussion, the feedback, as Sam said. And for those of you who are at the earlier session today, some of this will seem familiar. So where is the guidance on revenue? Well, it's in section 23. As Sam said, based on IFRS, but because IFRS for SMEs only has limited guidance on grants and donations, only really covering government grants, then the part 1 of section 23, covering the revenue from grants and donations, is quite a lot more substantial and mainly new, building on what's being done in other standard setters, particularly IPSASB, who've looked at non-exchange revenue for governments. And then we have part 2 of section 23, which deals with the revenue from contracts with customers. Not really going to be looking at that today, but it is consistent, based very much on what's in the latest draft of the third version of IFRS for SMEs, which should be issued in the next year or so. So what are we actually covering, looking at in this session? Basically, recognition. When do you put the revenue into your statement of income and expenses, and measurement at how much? That's what's covered in ED2, and both for grants and revenue contracts with customers, that's in section 23. Presentation, part of that was covered in ED1, where we looked at the income and expenses statement, the format of that. But the other key issue is going to be dealt with in exposure draft 3, looking at fund accounting and how that impacts or interacts with the revenue requirements. So moving on to the specifics for accounting for grants and donations. First question, does the agreement include terms that affect an MPO's ability to use resources? So first of all, do you have an agreement? Sometimes you may just be given money, no agreement. But if you do have an agreement, are there any terms that affect how your MPO can use that cash? If the answer is no, it's free donation, then that's what we call another funding arrangement, and you recognise revenue once you control the resources, usually when you receive the cash. If there are those conditions, restrictions, as they're often called, the next question is, do they meet that definition that we talked about earlier of an enforceable grant obligation? So is there an obligation on both the grant provider and the grant recipient? Are they enforceable, and are they quite specific about what you have to do? If the answer is no, then it's still another funding arrangement, and you would still recognise the revenue when you receive the cash. However, because there are those restrictions there that will limit what you can do, it's likely that these will be accounted for in separate funds, subject to fund accounting. That's coming in exposure draft 3, but it will effectively mean there's that distinction between those OFAs, other funding arrangements that have restrictions, and those that don't, in terms of how they're presented in the financial statements. And then when you do have those rights and obligations, then we're into enforceable grant arrangement territory, and that you recognise revenue as the obligations are met, which might be over time or might be at a point in time, typically at the end when you've done everything. So the 5-step model, first of all, identify your arrangement, identify the obligations within the arrangement. Some grants, there'll only be one, that's straightforward. Others, there'll be more than one, you'll need to identify them separately. Determine the transaction amount, what's the total of the grant? And then if you've got more than one obligation, you'll need to be able to separate that grant into the amount that relates to each obligation. That might be specified in the grant arrangement, or it may be that you have to estimate it based on, for example, the budgets that you've allocated to doing the work for each of those obligations. And then finally, as you meet those EGOs, as you satisfy those obligations, you recognise revenue. Might be over time, so when you've completed everything, when you've achieved the output, or it may be, sorry, that point in time would be when you've achieved the output, or it may be over time. So, for example, if you had a contract to deliver training courses over a series of 10 weeks, you might be recognizing so much for each course that you deliver. The 5-step model can lead to there being assets and liabilities. So if you have a situation where you do everything that you need to do to earn that revenue before the grant is received, then at that point you would recognize revenue and an asset as you satisfy those obligations. And that asset represents your entitlement to receive the grant in future. And then when you do receive the grant, you would de-recognize that asset. So you would debit cash and credit that asset representing your right to the grant. Effectively, it's work in progress. The other scenario, you get the grant first, so you satisfy your obligations after receiving the grant. And in that case, you recognize the grant and a liability when the cash comes in. And as the liability is that liability again is that requirement for you to satisfy the obligation, and then as you do so, then you would recognize revenue and de-recognize the liability. There are some complications. So around capital grants, for example, where you get grants to build assets, say buildings, the approach is the same as for other grants. You need to identify your separate EGOs, your separate enforceable grant obligations, and recognize revenue as you satisfy those. But where you have a requirement to construct an asset and then to use it, so it's build this building and use it for, say, 5 years at least to deliver education or medical services, then that obligation to construct the asset and then to use it afterwards will always be separate EGOs, and you'll need to split the grant that you receive into how much relates to the construction, how much relates to operating it afterwards. Multi-year grants, same principles apply, recognize revenue as you satisfy those obligations, and you do that even if the amount is only going to be received in future years. If you've met the obligations, then you would recognize the revenue as you do so. But if you're in a situation where you've made the agreement, but you're not going to do anything in the current year, the donor isn't going to make any payments in the current year, then you don't do anything at that point. You only start recognizing things in the financial statements once somebody starts doing something. So either when you receive it or once you start doing work towards the EGOs. That brings us on to the other funding arrangements, which is effectively any grant or donation that is not an enforceable grant arrangement. And as we've said, you recognize revenue when you control the resources, typically the cash, and you measure it at fair value of the resources received. For cash, that's not an issue. It's straightforward. It's how much have you received. It's more of an issue for where you receive non-cash items. So if you receive vehicles or buildings or inventory, measuring the fair value is more of an issue there, and we'll look at that shortly. The other thing to say is there's quite a spectrum of these other funding arrangements between those which have got no requirements for the NPO whatsoever. It's just here's cash to carry out your mission, do whatever you want, to those which say here's cash, we expect you to use it for this purpose, but without specifying particular outputs, particular activities, particular objectives. It's just use it in this area, but only in this area. And that distinction, it's quite a spectrum, but there will be a distinction in how you present that in the financial statements, because there'll be some of those OFAs which are presented without restrictions and some that were presented with restrictions. So that's fund accounting and coming in ED3. So we said there's an issue potentially with measuring the fair value of what you've received where it's non-cash. And INPAG recognises that can be challenging. And so there are some optional exceptions in some cases to make the accounting somewhat easier. So the first thing to say is if you get non-current assets, so buildings, cars, things like that, no exception, they're going to be significant. So you recognise them on receipt, measure them at their fair value. Second case, low value items for resale. So this is where the NPO perhaps runs a shop, receives donations of clothes or books or whatever it is, and then sells them to raise funds for to fund the NPO's mission. Recognizing those items at fair value when you receive them could be challenging. You don't know if you're going to be able to get that price when you sell them. So there is an option that you don't have to do that. So instead of recognizing revenue when you receive them and having to work out the fair value, you can do nothing when you receive them, but instead, when you sell them, recognize revenue at that point and measure it at the sale proceeds. So that will simplify things. You don't have to recognize any revenue when you receive it, just when you sell it. Next exception, items for own use or distribution. So this could be stationery, things like that for your own use. It might be medical supplies to either use in, if you're a medical charity, either to use in delivering services or to distribute if it's to service recipients. It could be food if you're running a food bank. And the option there is, again, you don't have to recognize things when you receive it, but you've got the option to instead just recognize revenue and expense when you use it or distribute it. And that will help where you receive things that are close to expiry date and may not be able to use them. And then finally, there may be rare situations where an NPO just can't measure the amounts and you just make a disclosure instead. So that could happen where you've got a small NPO, local NPO, first responder to an emergency situation, receiving items in, distributing them immediately, doesn't have the capacity to keep records for that, and instead you would just disclose that rather than trying to recognize the revenue and expense. Other thing you might receive is services in kind. So this is where you get volunteers providing their services to an NPO. And for some NPOs, that's significant. It's the bulk of what they do. So in terms of the accounting, two different approaches. If those services are critical, mission critical, so you can't deliver your mission without those services, then you recognize revenue and an expense as you receive them, where you can reliably measure that. And if you can't reliably measure it, then you'll need to make additional disclosures. So if some NPOs provide counselling services manned by volunteers, you don't have the information about those. If that's your key output and the only, and you can't provide that service without those volunteers, then you should be recognizing revenue and an expense there. And if you can't, then making disclosures. For everything else, stuff that's non-critical, but important still, then you're not required to recognize revenue and an expense, but you are permitted to do so. And if you don't, then you're encouraged to make disclosures about what you received and how it's helped. Moving on to the valuation of donated inventory. Mentioned, normally you would measure donated inventory at fair value. We've also got a work in progress exception. So if you were an NPO providing, say, legal services to refugees, and it takes time to build up the case, normal procedures would require you to recognize that work as work in progress as you prepare the case. There is an exception that allows you just to expense that, so you don't have to go through all the timesheet recording that would otherwise be required. And then for measurements, donated inventories at fair value, inventories held for distribution, so things you're going to potentially you'll just give to service recipients, rather than sort of cost or recoverable amount. You can measure those at the cost adjusted for service potential, loss of service potential, or at replacement cost. And we're actually going to look at simplifying that at the TAG meeting next week. And then finally, there's quite a few disclosures required. So that's in your slide pack. I won't waste time talking about that. Back to you, Sam.
Brilliant. Thank you, Paul. Let's come here. Right. So we are going to break it into breakout sessions of about 10-ish people. There will be a room for Spanish speakers. And Brian, will there be a room for French speakers? How many French speakers do we have? Is it a critical?
I don't see any French on your side.
How many?
We don't have any.
No French. Okay. So there won't be a French room, but there will be a Spanish room. I'd like, if you're in room 1, please start with question 1. Room 2, question 2. Room 3, question 3. If there is a room 4, will there be a room 4, Brian? Possibly. Room 4 can start with question 1. So start with that question, but you can then, if you feel that you've given it some justice, you can move on to the other questions. It would be great if there's somebody in your group who could take responsibility for recording, typing down, writing down some of the key bullet points so that they can be shared back in the main group when we come back. Some people have kindly volunteered to actually record the session onto their laptops and share it with us. If you've done that, thank you very much. And if anybody else would like to volunteer, that would be very helpful for us. As hosts, we can't record the breakouts, and yet we're really obviously keen to hear the richness of the discussion there. So at a very minimum, please make sure your key ideas are jotted down and reflected in the chat when we come back. So I hope that's all right. We've got 20 minutes in the breakouts. Hopefully that's long enough to get to know each other a bit and chat and find your people, your other finance non-profit people who speak the same language and feel the same pains that you do. So Brian, thank you. Please open the breakouts. Super. So welcome back from those breakouts. I hope you had some good conversations and discussions. So what we're going to do now is launch a poll that we hope you'll be able to answer. And at the same time, or there's time to do it, share some of the key points from your questions in your discussion groups in the chat, if that's possible. So Brian, if you could, here's the poll. Excellent. So I won't do too much talking. I'll give you some thinking space to finish the poll and share your thoughts in the chat, especially if one of your answers to the poll questions is yes, but, or don't agree. It would be really good to have some value add in the chat. If you want to type in Spanish, that's also fine. I'll give you some time to do that. Thank you, Joe. I can see the first summaries coming up in the chat. Thank you very much. So if you have any colour to add to your responses in the poll, please do so in the chat. Examples, reasons, very valuable for us. So I'm just going to reflect briefly on some of the points coming out in the chat, which are really interesting. And I can see shock. Surely we're not asking charities to value the time donated by volunteers, and somebody else saying they're invaluable. Wouldn't it be like almost belittling to assign a value? Why would we do this? So to give you some sort of reflection back on that, the reason that we're not doing it for all volunteers and all services donated is because of the practicality. But if a organization is utterly dependent, it's mission critical that these volunteer services are given, and that the MPO couldn't operate without them, that is really important information. Many people also thought that it's part of the superpower of non-profits is this ability for people to want to give their time and to be able to demonstrate that in their financial statements as donated time actually strengthens their financial statements and strengthens their financial standing. So there are some benefits and there are some costs, and this is a very active debate. So it's really interesting to hear those views. Thank you. I'm seeing lots of comments about fair value. The value could be different from different perspectives. Need to define fair value very carefully. How do we define mission critical? It's quite subjective. With material, the better. Again, challenges about the monetization aspect of volunteer time, and it feels a bit distasteful sometimes. So I think these are really important points. Right, I want to give you one more minute if anyone wants to finish the poll. 75% of you have finished. Let's give you another minute or so. I want to watch the clock. Within 2 minutes, we'll be moving on to the next topic. Okay, so let me end the poll there and share it so you can see. So question 1, which is about the structure of section 23, broad support, with some comments. Question 2, about grant revenue only being deferred if there's a present obligation. Again, pretty broad support for that. Question 3, the proposals for disclosure on grant revenue, providing an appropriate level of transparency. That's 73% saying yes and 18% yes, but. And then donations in kind being measured at fair value. This is obviously a hot one. 57% saying yes, 30% saying yes, but, which I guess is some of the comments that we've seen reflected, and 13% saying no. Services in kind shouldn't be recognised unless they're mission critical. So we've got 57% saying yes, 19 yes, but, 19 no. So again, I think that reflects some of the comments in the chat. Permitted exceptions for the recognition of some gifts in kind, for those pragmatic exceptions. 76% saying yes, 14 yes, but. There's some really interesting range of views there. That's fantastic. Thank you very much. And anytime you're welcome to add more comments in the chat. Now, this is a super speeded up roundtable. Unfortunately, there isn't time to digest and discuss all of the richness of the comments there. Apologies for that, but we wanted to keep the session 90 minutes rather than the 3 hours that we did last year. So without further ado, we're going to move on to the second section of our session today. And I think I'm handing over to Karen.
To me, thank you very much, Sam. Paul, could you move us on to the next slide? So as before, I'm just gonna spend a couple of minutes just running you through some of the key proposals that are in exposure draft 3, and then again allow a discussion before coming back for feedback. So if we can move to the next slide. So I'm going to start first with foreign currency translation. This was a topic that was added in to this phase of the development of INPAG, because we had a lot of feedback about practical difficulties for MPOs. And the 3 practical difficulties that were raised were around exchange rate risk, and who bears that, the requirement to use specific presentation rates in some grant agreements, and the third area was around where cash is received and put into a foreign currency bank account, but there are multiple grants in that bank account, and how do you deal with exchange gains and losses on individual grant arrangements where they're pulled together. And it's because of those things that we added foreign currency into this exposure draft. If I can have the next slide, please. But in terms of what we heard in terms of the issues, what we heard were that the problems that non-profits face relate mostly to presentation and disclosure, particularly in relation to grant arrangements. And so that is the focus about trying to provide transparency and decision useful information. And what we haven't done in this exposure draft is look at the accounting for foreign exchange gains and losses. So not about recognition and measurement. The next slide, please. We've also included some small adaptations to other text in the documents, and this is mostly to bring in MPO specific items. So, for example, in terms of determining an MPO's functional currency, we've included factors like grants and donations, either making them or receiving them, that might be important in determining a functional currency. And in terms of the scope of the section, in terms of the types of transactions that are covered, we've again made clear that this also applies to grant arrangements. Can I have the next slide, please? So you'll have heard before, and as in the previous session, that we are grants and donations. We are categorizing either to be an enforceable grant arrangement or another funding arrangement. And given that most of the issues are about grants and donations, that features in here as well. And one of the important principles that is outlined in exposure draft 3 is that, exposure draft 2, is that any foreign currency gains or losses that relate to a grant arrangement should follow the same presentation of that grant arrangement. So Paul mentioned earlier that in exposure draft 3, we'll be looking at fund accounting, which will look at what's presented as being a fund with restrictions and what isn't. And so that principle is going to be important as we get on to how the information is presented. Can I have the next slide, please? These proposals also have implications for enforceable grant arrangements and how they operate. So if there's an exchange gain, there might be a refund required, or the gain could be permitted to be used for other purposes. If there's a loss, there might be a need for additional activity because the money's not going so far, which needs to be funded from free reserves. So those points are picked up in the guidance. Next slide, please. I mentioned about foreign currency bank accounts and the pooling. That's also recognised in the guidance, and the need for an MPO to determine an allocation method. And that allocation method will need to be specific to the organisation. But the whole point is to try and find a suitable proxy for a fund balance. Next slide, please. In terms of disclosure requirements, I think the key points that are in the proposals to point out is the requirement to disclose exchange gains and losses related to grant arrangements where that results in a surplus or deficit on funds within restrictions, and this is to provide transparency over those, and that is where MPOs were particularly asking where there's a loss, and also an explanation of movements, particularly if you have to fund things, fund losses from free reserves. Next slide, please. As well as foreign currency, we considered 8 other sections in Exposure Draft 2. You'll see that there is a cross against shared-based payments. You can just move to the next slide. We reached the conclusion that share-based payments should not be part of INPAG, and that is predominantly because of the characteristics of an MPO, where surpluses are used for the MPO's purpose, not for private benefits and not to be distributed. And as equity is uncommon, and we haven't actually heard of any equity with MPOs that's traded, we just didn't think it was appropriate. Next slide, please. And that has implications for the section on employee benefits, where we have removed share-based payments as part of remuneration, and equally profit sharing, for the same reasons that, you know, the surpluses should be reinvested for the beneficiaries. But we have retained reference to bonus, and so that's a proposal on which we are seeking feedback. Next slide, please. And this is kind of my other slide. So these are the other sections that are in Exposure Draft 2. They are principally editorial changes. The changes to make sure that we're using the same statement names and terms, and to align with adjustments that we have made elsewhere. So, for example, that removal of share-based payments. So less change in those sections, but included for completeness. So that's a very quick whistle-stop tour of the other topics that are in Exposure Draft 2.
Super, thank you, Karen. So we're going to go into breakouts again. So again, if you're in group 1, please start with question 1. Group 2, start with question 2. Group 3, start with question 3. Spanish, start where you like. Brian, are you able to post these questions into the chat? Yes, they are there, and hopefully in Spanish as well. So again, you're going to have 20 minutes, maybe 18 minutes in the breakouts, and a chance to meet each other and share your thoughts on these. And again, if somebody can take some notes and share those in the main chat, that's incredibly helpful for us. All right. If you Super, welcome back, everybody. I hope your discussions weren't cut short too abruptly. There's nothing worse than being pulled out at the last minute, but welcome back. In the last few minutes of this session, we're going to do the same thing. We're going to share a poll and invite you to share the key points from your discussion to the questions in the chat. So Brian, if you would launch poll 4. I might be naive in thinking maybe some of these are less controversial, but surprise me. Let's see what comes up. So I'll stop talking and give you some time to do the poll and share your thoughts in the chat. Thank you. Okay, I can see 5 of you yet to respond to the poll. I might just give another 30 seconds in case anybody else wants to complete the poll. And I'll share the results, which are very interesting. Can see comments about wanting to define restricted. This has been a part of the challenge of the 3-part exposure draft. We've exposed guidance on foreign exchange that uses language about restricted and unrestricted, and yet the definition of restricted, unrestricted is going to come in ED3. So you're going to have to sort of suspend, but you're quite right, it needs defining, and it will be in ED3. Comments about the functional currency needing to be linked to the country where you live. Otherwise, there could be too many currencies. And how the gain or loss, if it's not paid for by the donor, has to be funded with unrestricted. And I think there's an example in the video that addresses this, so that if the loss, it's a loss and it relates to a restricted grant, it's put in that grant fund to show that it relates to that grant, but then you do an inter-funds transfer to show that that loss is having to be covered by unrestricted funds. So I think there's this is really interesting to see this, how you can't charge something to a grant donor if they won't pay for it. And yet we want to demonstrate that transparency, that look, there was a loss on this grant as part of transparency and negotiation and all sorts of things. So very useful, that. Okay, I'm going to end the poll. 27, only 2 people not responded. That's very good. And I'll share the results. So first question, do you agree that exchange losses are shown in the same fund as the transaction? So there's mostly yeses and yes, but, and then a no, which might link to the comments that were in the chat. And if you've got more to add there, that's fantastic. Are there NP? Now, this is an interesting question, because most of them, yes means you agree with what we've done in INPAG, and no means you don't agree. But this one is a bit reversed. Are there any NPO-specific issues associated with foreign currency translation that affect recognition and measurement? And we have basically said we don't think there are. We're only going to talk about presentation. We're not going to change the accounting rules. So the fact that quite a few people are saying yes, 65% are saying yes, and a smaller number saying no, it would be great to have some examples. What are the specific examples where recognition and measurement are impacted because of a grant situation that requires a different type of accounting rules? If you could share those examples, that would be good. This is such a head-hurty, complex topic. Examples are really helpful. Talking about things in theory can get really hard. So thank you for that. Then, given the characteristics of NPOs, do you agree that the guidance on share-based payments is not required? Nearly all yes, but there's a few no's and yes buts. What we have done is I think assume that we won't put it in the main INPAG, but if in the instance where an organization does have equity claims, which we believe is rare, they can refer to IFRS for SME and use that guidance. But keeping it out because of the majority. But really interested to hear your thoughts on that. So those were the 3 questions, I think. Is that all? Yeah, 3 questions. And some fantastic comments here in the chat. Very useful. Okay, so if there's anybody who wants to add anything else there in the chat, please do. Otherwise, I would like to thank very much my colleagues at SIPFA, Karen, Sarah, and Paul, for all their efforts. Thank you to each of you. And I want to also just again recognize some of you are country champions, governance group members, PAG members, and all of you who just interested stakeholders putting in some real time and effort to dive into these proposals and share your views. To submit a substantive response, I hope some of you are planning on doing that. You visit the website, INPAG, have your say. There's a template you can download and upload through the website. We will also be releasing a SurveyMonkey survey on the 1st of March. There's slightly different questions. Obviously, there's much more depth in a full-bodied response. So if that's you, please do that. That is our preferred way of getting rich feedback. Otherwise, there is a sort of slightly easier to use survey that will be coming up on the 1st of March as well. So I hope today has been useful for you to flesh out some of your thinking and test some of your ideas and just meet each other. And it's been a pleasure. Thank you very, very much, all of you. We will be sharing the recording and an anonymized version or summary of the chat. So just for accountability and transparency purposes as part of the project. Thank you very, very much.